Yes, hi, good evening, everyone. We have, so I welcome you all for this GST sectoral series, virtual series part 2. We have our learned speaker as well, and the coordinator CA Praveen Khemka, and our speaker for the day, CA Amit Bothra ji. I would request CA Praveen Khemka ji to introduce our learned speaker. Over to you, Praveen.
Thank you, sir, for giving me the opportunity. Good evening to all of you. Mr. Amit has more than 18 years of experience in advising clients on various indirect matters. Amit has assisted clients across industries like IT, technology, telecommunication, banking, NBFC, ATM manufacturers, financial intermediary, and advisors, etc. Amechi has partnered with Gift City for several initiatives in the past, especially with the representation to CBIC for exemption to intermediary service from GST. Amechi has various role and position at EY, like Amechi has rich experience in assisting clients in matters related to advising clients on complex indirect tax issues, suggesting tax planning structure, assessing and strategizing tax risk, guiding through assessment. Amiji has advised several clients in relation to contract structuring, keeping in mind that interplay of various indirect taxes and identifying planning opportunities. Amiji has handled advisory, compliance, audit, investigation, litigation structures, due diligence related assignments during his work experience. His Amiji has been actively involved in making representation and liaising with government authorities on reforms in tax laws, with particular reference to GST, service tax, and foreign trade policy. And Amish is an advised speaker on indirect tax matter before various tax forms and study circles. Thank you, sir. Amish, sir, you can continue.
Thank you, Utkarshji. Thank you, Praveenji. Thank you all the WIRC committee members, organizing members, and all those people who have helped me to get to this session today by spoon feeding me, hand holding me into the link and everything that is required for a presenter to present. So thank you so much, all of you. Today, I want to also laud the WIRC for bringing out in the sectoral series for GST. I think it is an excellent idea to do so. I understand a few sectors have already been covered. Today, I'm here before you to cover GST aspects around IT and software industry in some more detail. And I hope this is a useful session for all of you. Broadly, in terms of the structure of our discussion today, the way it is planned, I want you to come closer to the IT and the technology space by giving you a glimpse of how this sector continues to be the growth driver as far as services sector in India is concerned, and whether it is a COVID impact or whether it is the entire cloud related scaling that is happening. There's a mammoth growth both in terms of employment opportunities and innovation in this country. Spending some time on understanding some of the subsectors and what is really the length and the breadth of the IT sector. It's anyways very fragile and very open, so it keeps changing every now and then. We will spend some time discussing what are the GST aspects around the IT and the software industry. Discuss some of the FAQs that the CBIs has issued in the past, which still are relevant for the IT sector. Aspects such as the impact on data centers, impact on account of intermediary services, which is the heart of all the issues from a GST perspective as far as the IT industry is concerned, is an area where we will spend some time. I will also be interfacing you with the STPI and SEZ scheme on an overall high level basis, the recent guidelines around work from home, and then finally a quick analysis on various incentives that are granted by the state and the central government uh, for the IT and the software sector. In the last part of the session, I really wanted to just summarize, because this is the group of chartered accountants who may be practicing, who may be budding professionals, and tomorrow if you need to go and visit your client who is in this sector, what are the avenues for you, where you can do business with those clients. So we'll just quickly look at those avenues and discuss some in some brief detail. uh, Finally, I want to also leave some time for Q&A. So hopefully this is not going to be a 2-hour session. We'll try and wrap it up earlier, but we please keep posting your questions as you get. We will take it at the end of the session. So let's get started. I think this just getting you closer to the sector, for both global and Indian end user enterprises. Technology was the panacea that enabled firms to not just keep the lights on, but also pivot their business models to online mode, adapt product and services to emerging market forces, and enable collaboration in a distributed work model. Financial year 2022, which is just close by, has been a tipping point for the IT and the software industry. The year in which the industry crossed $200 billion in total revenue and 5 million of total workforce in this year. The top 3 Indian IT companies, whether it is TCS, Wipro, or Infosys, are expected to offer over 1 lakh job opportunities due to the increasing demand for talent. Let me get my slides up, so that you have a perspective on where what are the broad numbers and contours to this industry. I'm hoping it will be up in a bit. Financial year 22, therefore, has been a spectacular year of India's technology industry. It recorded a 15.5% growth. This is the highest ever growth in the sector. A combination of digital and innovation was the industry's key success for winning in this year. COVID and the related work from home was visibly instrumental in accelerating tech adoption. So everybody, whether it is individuals, whether it is the corporations, whether it is government, I think we all were kind of pushed and forced to adopt the technology. And today, even if we are generation X and not Y, I mean we are very comfortable interacting with each other through technology mode. And look at this session today, right? I mean, these sessions were always organized in a tight room with a lot of chairs and people, but today we can do this at a very comfortable place, sitting in our offices, and still accessing the learning in the best way. In another landmark that the industry achieved was to cross 5 million jobs in total direct workforce. This is at the highest ever levels. Today, the share of digital talent in India. So basically now 1 out of the 3 IT professionals are digitally enabled professionals, and this kind of ratio is one of the best in the world. I have a flickering bandwidth, so I'll just put my camera off for a while and see if this becomes better. Okay, so since the government of India liberalized the IT and telecommunication sector in the late 1990s, it has provided the right impetus to companies working in this sector. India offers high quality IT and IT enabled services at low cost. Using state-of-the-art technology, convergence has led to lowering of tariffs, plentiful ability of or availability of bandwidth at a very low cost. Across the globe, if you look at the bandwidth cost that is offered in India, it is one of the lowest ever. India's information and communication technology (ICT) organizations are counted among one of the best and the most reputed globally. Some of the advantages that India offers for IT companies, and this has been something that the country has worked for the last 2 decades. Skilled and inexpensive IT resources, they are available in plenty. Uh, a thriving software industry backed by government initiatives, helpful initiatives like rationalization of taxes. Some of them we will see from a GST perspective. Availability of English speaking workforce. Now this has been a key driver for sectors such as the business process management, or what we call as global in-house centers, capability centers. In other terms, we also call them BPOs, KPOs. So the English speaking talent has been a key driver for the sectors to thrive in India. Some of the early initiatives that we've made as a country on upgrading our IT infrastructure has immensely helped us. And I think from a GST perspective, it is important that we look at the infrastructure sector separately and differentially, and ensure that they continue to be most competitive in the global overall scale. If you were to just summarize, what we discussed till now, the key drivers why in the IT and the ITA sector, software development sector in India has thrived and grown and survived is on account of maintaining cost advantage, the stability in policies that the government has introduced over the last 2 years, especially after 1990, clarity of all the regulations that apply to this sector, and of course the infra focus that has been the key for the last 2 decades. If we move ahead, understanding in this sector and understanding the subsectors of IT and software, broadly IT and the business process management group can be categorized into IT services, BPM. They are also called as global in-house centers or global capability centers, software products, and engineering R&D services. And then they are all supported by a infrastructure, which is typically in the form of a data center or telecom network. IT services, they largely are project management, software development, deployment, maintenance, IT consulting, IT service management. So they're all part of the IT service subsector. In recent years, the sector has grown to provide overall IT solutions such as consulting, system integration, testing, IT infrastructure, banking, financial services, and insurance. This sector has seen the most disruptive phase of IT services the most recently. If you look at it again from a GST perspective, there is so much of consulting, so much of engineering, so much of deployment that we have seen since the onset of GST, whether it is dealing with our ERPs, whether it is dealing with service providers, or building your own platforms as organizations to deal with various GST compliances and changes in the accounting processes. Business process management, or GIC, GCCs, in terms of value, in terms of volume, takes the lion's share of IT and software sector. So these are basically the KPOs and the BPOs and all outsourced managed services which are typically housed in this segment. This subsector is engaged with overall management and improvement of business processes of any enterprise, and this typically is a global center set up in a low cost setup like India. It follows a systematic approach for identification, design, executing, documenting, measuring all kinds of business processes to attain expected results. So these are typically in a very layman term, these are processes which are are repetitive, which are process oriented, and which can have a structure created, and then anybody who needs to deliver can just follow the structure and deliver services. Areas like financial accounting management, human resource administration, knowledge services, supply chain, these areas have typically been handled by the BPM subsector. Software products is a subsector that offers services in software products, which is known as software product subsector. Software products are made available to users in the form of either commercial or non-commercial products. The users are subjected to pay one-time license fee or a usage fee to use these commercial software products. The subscription-based model are typically known as software as a service, SaaS. You would have heard this term, where users pay like a monthly or an annual charge for accessing and using the software. Integration and deployment of software, product quality, quality assurance, testing are some of the responsibilities that come under the category of software products. Then finally, engineering R&D. This is seen the highest level of disruption after COVID. Engineering R&D and is a very important subsector for the IT BPM industry. It involves product or service invention, optimization, enhancement of any IT product or asset. The largest contribution to revenue base of any engineering R&D division for comes from sectors such as telecom and semiconductors and automotive industries. So these are some of the sectors where the engineering R&D IT division typically serves. Again, like I mentioned, to serve all of these subsectors, availability of high-end bandwidth, power, data storage, and redundancy support 24/7 is a core essential. Data centers and other infrastructure organizations have equally seen, therefore, a mammoth growth and opportunity in India. So we'll of course cover sectoral issues around some of these subsectors in detail in the next few minutes. So coming to why with this setup, now that we understand what are the kind of sectors and subsectors involved in IT and software, let us understand how GST has impacted and how are these sectors faring, especially in a VAT or a service tax regime, and how do they compare themselves to a service tax period. The earlier VAT service tax regime in India was complicated due to multiple taxes, innumerable compliance obligations coming out of various laws, and then the most important deficiency of the earlier model was tax cascading. So tax on tax used to apply on typically the same product, same value. Under the GST regime, it is far more simpler that way, especially for the IT sector. The impact of cascading, whether it is a package software which used to attract both VAT and service tax, and VAT could have been 15% or 14% in some states. Service tax used to be around 15% that time. There was also excise duty levied in case there was a manufacturing of any IT products involved. So, for example, if a software came on a CD, DVD, or hard disk, typically excise duty used to apply on the manufactured product. VAT used to apply on sale, and service tax also used to be applied on that software. Further, in case if you imported software on a media or a paper license, customs duty used to also apply on the import, unless those have been specifically exempted. So, with all such complications and double taxations, the old regime was very, very taxing and lesser transparent than as compared to GST. So since introduction of GST, the IT sector has seen a mixed impact on various proposals that have been introduced in the legislation over the last 5 years. As per the GST law, many items used in the industry like a printer or a photocopying machine, fax machine, ink cartridges, which typically anybody, any organization will use on a routine basis. They're all taxed now at 18%. They were introduced at 28% when GST was initially introduced in 2017, but the rates were rationalized later on. Software services are charged at 18% under GST, as compared to 15% service tax in the previous system. This may have resulted into some impact on cost, but there is still better availability of credit as far as the software industry is concerned. And like other SSEs, IT companies have spent significant amount of time in investments in hardware and software to make their systems in compliance with GST. And especially during the 2017 and 2019 phase, where the GST compliance process underwent significant changes, and new processes were introduced. So the IT systems had to be upgraded each time. At the same time, this also became a business opportunity for players who were supplying such software, supplying such hardware, and they've had a gala time during that period. So availability of input credit has generally been a beneficial change for this sector. There are a few areas where credit is still not eligible for the IT sector, and so for the other assessees as well. There are regular representations made by organizations like NASSCOM or CII or FICCI, especially driven by the IT sector. Those players are very, very active in advocacy with the Central Board of Indirect Taxes, and these representations typically highlight areas where credits are being denied. For example, rent a cab, medical insurance for employees, because this is a people-oriented sector. The brunt of a non-availability of credit is most felt in the IT and the software space. GST is, of course, effectively removing some cascading effect of taxes on all the supplies of IT of goods and services. So now, credit of goods can be offsetted against liability of services. Export of various IT-related services such as software development, consultancy, BPO, they're all regarded as a zero-rated supply. And at the same time, you're allowed credit of input taxes. So if you're accumulating those credits, you're also allowed to claim refund on a periodic basis from the government on any accumulation of input tax credit, especially where your output services are qualifying as a zero-rated supply. The even for freelancers, like bloggers, etc., GST will apply only if they've crossed the threshold, which has been set for all the assessees, the aggregate turnover. So unless you cross that turnover, bloggers, etc., today who earn a lot of revenue from their blogging activity, they don't need to register for GST or pay taxes. So, the exporters, like the export of services, in this sector, you will find a lot of exporters of services. Market in India for IT was primarily developed for serving the global markets. But if you have a client which is exporting services, you need to do those compliance like filing LUT every year, getting that in place, ensuring that you've recovered the proceeds in convertible foreign exchange or modes which have been approved by RBI within the time prescribed, which is say 1 year. There are several incentives that may be applicable to your clients if they are based in SEZ, STPI, or even any domestic area. So those you have to be very, very mindful of. We'll cover those aspects of STPI, SEZ, and some of the incentives in detail in some time. If services were to be supplied within the country, which means the recipient and the supplier are located within India, the place of supply is typically determined by the location of the service recipient, and that is again determined through contractual arrangements, contractual addresses that have been agreed between the two parties. So that is the way to determine place of supply as far as services are concerned, as far as goods are concerned, the place of supply will be determined based on the location of delivery. If there has been a moment, if there is no movement of goods involved, then it will again go back to the contractual basis. If there are cross-border supplies, typically a cross-border supply of services, and in the IT space, you will find a lot of players engaging in cross-border supplies. These services typically qualify as an export of service, which means that GST is not payable on those services, or if required, GST can be offered on the value of export, and a rebate can be claimed. So refund can be claimed on either counts. Either you claim a refund of accumulated balance of input tax credit, or you utilize the input tax credit to offer GST on the value of services that you've exported and claim that back from the government as rebate. I think you should only bear in mind that if you are located in an STPI or a EOU park, or you register as an EOU unit or STP unit, then the option of supply of services with payment of IGST and claiming a rebate or refund is not available to you. The government has, over the period of time, issued several clarifications on various questions that were raised by clients and representations dealing with or concerning with IT sector. I think it is relevant for us to go through some of these questions and the responses that the government has given. I think good throws decent clarity on how should you analyze GST implications on various transactions, on various scenarios for your various clients in this sector. So for example, in the FAQ, a question was whether software is regarded as goods or service in GST. If you've been in practice for some time, you would know that this was a very, very hot debate, especially in the VAT and the service tax period, right? And various case laws going either ways. Supreme Court interpreting this in the case of BSNL and several other judgments. There was still so much confusion about whether software which is delivered electronically, where license comes on a paper media, is it in the character of a goods or services. It is still relevant under GST to identify whether software is goods or services, because the place of supply can change or can vary based on whether it is goods or services. So in terms of Schedule 2 of the CGST Act, any development, design, programming, customization, adaptation, upgradation, or enhancement of information technology software, or a temporary transfer of right to use or enjoy any IP in the software, are treated as transactions of services. But if a pre-developed or a pre-designed software is supplied in any medium or a storage device, such as a CD, USB, etc., through use of encryption keys, the same is treated as a supply of goods. Right? So that's the critical difference. Again, from a comparative perspective, because in the past rates were different, credit availability was limited. It did make a lot of impact, but today, whether it is goods or services, the rate of the tax is the same. So to some extent, or to a large extent, even if there have been cases of not categorizing such transactions ideally as goods or services, from a tax perspective, those transactions have had a neutral effect. So if these kind of development, design, or programming or upgradation, enhancement kind of services have been designated as services, what is the relevance of doing that? Like I said, the relevance is to determine the place of supply. So the same would be applicable in situations of supply of services involving a temporary transfer, or permitting the right to use any IP the HSN, the rate of tax will have to be then therefore determined as those of the services in the respective HSN schedule. Whether export of software services attract GST, if the software services are exported, they do qualify as zero rated supply. Even if you supply that to an SEZ unit, that is again regarded as a zero rated supply. There are compliances that the exporter will have to undertake, which includes filing of LUT, issuing a export invoice, and choosing to pay GST on those services, or exporting those services without payment of GST. So that choice has to be made by the exporter of that software. How do you determine whether IT services provided by you constitute export of services? I mean, these conditions which you can see on the screen are relevant, and they have to be satisfied in toto. So for any service to qualify as an export, the supplier should be located in India, recipient should be located outside India, and outside India means even outside SEZ. SEZ is pretty much in India. Place of supply should be outside India. The payment for such services should be received in convertible foreign exchange or any mode, and this was amended recently, or any mode permitted by RBI, which means even if you're getting INR through a Vostro route or a Nostro route, that is a permitted receipt as far as this provision is concerned, and that the supplier and recipient should not be merely establishment of distinct person, which means the legal entity of the supplier and services should be different. It should not be a case of a branch or a liaison office or a project office serving their head office. So if that is the case, then that service has been specifically exempted from GST. It does not qualify as an export, but it will become a exempt supply, provided the place of supply continues to be outside India. So that is a important determinant to advise whether GST is payable on such services or is not payable on those services. There was, I think, another question on, would you be liable to pay GST on reverse charge if the foreign supplier of software from whom you buy, the services is registered under GST and were to accept payment in INR? So whether for import of services, will it matter if the payment is made by the recipient in INR or in dollars? I mean, you will continue to be liable to pay GST under reverse charge mechanism. The mode of payment has no relevance to determine whether GST is payable on those supply of services. It is the important element for import of services is the fact that you as a recipient are located in India and the place of supply for that service is in India. So if the place of supply is in India, that service will be liable to GST under reverse charge. Now, incidentally, for import of services, even if the supply of services is coming from HO to a branch office, that supply, while it is supplied by distinct person to another distinct person, that supply is still liable to GST under reverse charge. Unlike the treatment on export where it has been specifically exempted from GST. How do you determine the place of supply for any ITS services? You go through the IGST Act and look at section 12 and 13. In most cases in this sector, in the industry, if you are dealing with a software service or a IT delivery service or a back office service, the usual location of the recipient will determine the place of supply. So if you are a supplier, say based in Mumbai, and your customer is based in Bangalore, you would know that you need to register yourself in Mumbai. You don't need to register in every location where your customer is. So you don't need to register in Bangalore unless you have a office set up and a delivery center also in that particular state. if you have arrangements where defective parts were to be sent to, say, a mother warehouse or a repairing center by the downstream repairing centers, what is the tax liability on such supply? The board has clarified that the defective parts shall be sent by repair on a delivery challan accompanied by such e-way bill as may be prescribed. GST shall be chargeable on the repair amount, including the cost of parts charged by the repairing center. So GST applies both on consumables as well as services. The charge for consumables as well as services, GST will need to be offered. What is the tax liability in a scenario where supplies are made from multiple locations in different states of a supplier to a recipient under, say, a single contract? Now, you will find this in the context of L1 support or a AMC kind of service, where the deliveries may be actually happening from various locations, but there is a single contract with your customer for say a pan-India service delivery, right? Now, the way the government has clarified is, you should visualize this as two different arrangements. One arrangement where you as a supplier are providing services to your recipient and the contractual address is relevant. So the place where the recipient is located as per the contract, the address mentioned in the contract will be your place of supply as far as service delivered from by you to your customer. Because individual locations are separate GST registrations and they are deemed persons under the law or distinct person under the law. There are also therefore supplies coming from these various other locations into the contractual location of the service provider. So those supplies will again be chargeable to IGST, coming from different states. So this is how those kind of arrangements where you do a central contracting model but a distributed delivery will be taxed. If you are a unit in DTA and there is another unit that you have in SEZ, I mean, do you need? Can you do with the same registration if they are in the same state? I think there is a provision now and under the IGST Act, and there were clarifications issued by the board that you will need separate registration, for your SEZ office. So if you have an SEZ office and you have a office outside the SEZ, whether it is in the STPI park or whether it is in the DTA, you will need two different registrations. At the same time, if you have multiple SEZ units in in the same SEZ, then all those offices can be registered under the single registration. You don't need a separate registration for every SEZ unit in that particular SEZ location. If if taking an example of mixed supply or a composite supply, if you want to supply, say, a laptop which is given under a laptop bag, what would be the rate of tax? It will be the these kind of supplies are regarded as supply made in the ordinary course of business, and they're regarded as composite supply. The essential principal supply in this is the laptop, and therefore the rate of laptop becomes the relevant rate that you need to apply on that, on the value of the supply. If you're operating in any online database access services from, say, a company located outside India, do you have to pay any reverse charge? If the recipient is registered, you have to pay GST under reverse charge. If you are a B2C, in the sense you are not registered as a customer and you're not even government, then because of the changes made in the OIDA provisions, online information database access retrieval services, the company which is outside India, whether it is, say, a Google, Amazon, etc., they need to register in India to provide services to a customer who is not registered. So that company will have to obtain a registration and pay taxes and undertake all compliances as is stipulated in the law. So this is very, very unique to cases where such companies which run databases and which give access to various blogs, etc., email account. So if they charge you a particular amount and you are a non-registered customer, which means you don't hold a GST registration, then that organization, that company needs to register in India from a GST perspective. So what would be, and finally, what would be the tax liability on replacement of parts where no consideration is charged, say under a warranty supply? Now, there is a fine distinction that you should understand of warranty and EMC services. For warranty, in your original price for supply of services or goods, you would have already covered your charges towards warranty, and therefore when you move materials for under the warranty period for warranty replacements, those can be moved under a delivery challan, and those need not be subject to GST. But if these are supplies made under a AMC model, then you need to examine the GST impact on those transactions separately. So these are some of the typical issues that were clarified by the government over a period of time, and most of them are relevant to the IT and the software sector, especially the business process management sector. We spoke about data centers and how important data center is for the overall IT and software ecosystem. One of the issues that a typical data center faces in India is that credit is denied to them, or is being denied to them on land acquisition or construction of building, and they spend a lot of amounts, a lot of capex comes in for creating an infrastructure of that kind. So I think we should again discuss and understand what is the proposition of data center, and this sector has made representations again to the government. So let us spend some time understanding that issue as well. I mean, data centers are phenomenally important to the IT sector. There are, in fact, in the last budget, you would remember, Honorable Finance Minister notified infrastructure status to this industry, thereby allowing and permitting a lot of funding coming to this sector, free or easy availability of funding even from the domestic market. So that is an important step towards allocating more fund and infrastructure towards the data center, because the demand in India is far more than the capacity that we have today. It is said that to meet the demand for the next 2 years, we don't even have enough number of projects in the pipeline to serve the bandwidth requirement of the future. With over 1 billion mobile phones and more than 700 million internet subscribers, the kind of data, and when we move to 5G, the kind of space, cloud space that is required is going to be phenomenal. The need for data center infrastructure within the boundaries of the country is further necessitated by laws such as data localization laws, which are expected to come, and for protection of digital sovereignty of the country in an increasingly connected world. India has the geographical advantage, easy availability of economic resources, global connectivity, whether it is submarine cables. Most of you would know, these cable stations are available in cities like Mumbai, Chennai, Trivandrum, Kochi. So these places have landing stations established by organizations like Tata Communication, Reliance, and Airtel, and Vodafone, and so many others have their landing stations there. So these the fundamental infrastructure is available in the country at all these points. The the need for data center infrastructure in the country has also opened up investment opportunities for this sector. a typical data center may require funding of around 2,000, 3,000 crores of funding. If you were to set up a typical data center of a hyperscale level for say for co-location or other services. So that is the kind of investment that is required to establish a formulated data center. If you look at the GST provisions, under section 17(5), subsection C and D of the CGST Act, input tax credit is not available against any service, goods, or both used for construction of an immovable property. Given this, credit in relation to construction materials such as cement, steel, concrete, iron are not available. If the land is acquired on a long-term lease, this has been debated or debatable issue, but most of the people are now offering GST on lease of land, but credit is not available to companies acquiring the land for the purpose of construction, because it becomes, as per the authorities, it becomes an input for undertaking construction services. While a typical commercial building, and if you compare that with a data center, I mean they are very, very different. A data center building is core to provision of storage, hosting, and networking services. The the design of that particular facility is for flexibility and scalability. So that particular site, the building layout, the floor layout, electrical systems, mechanism design, modularity of that particular premises, they're all very, very different than a commercial building. The design and construction of a data center is directly linked to the nature of offering that is to be made. Typically, you'll have data centers, which will be housed on the base level or a level above. You don't have data centers using a high-rise tower. So the constructions are very, very different. Of course, technologies are changing, and vertical data centers are going to emerge in the next near future. But these buildings, the design of that building is very, very different. If you look at the from a very broad level, these look like a a large warehouse center, etc. So that's the look of those buildings. They need to have a high density to carry a lot of weight. The servers and the racks that are placed in the data center, they typically are they're very, very heavy equipment. So the building has to basically take that load which is maintained at those sites. Also, a typical data center will have a 30 megawatt or 60 megawatt kind of a power requirement. So to ensure that fire equipment and power availability, substation. So again, the infrastructure spend is very, very different than a typical commercial building. I mean, given this, the data center industry wants to therefore call the building as a plant, because for them building is an essential infrastructure which helps them derive revenue. So the petition that these guys have made to the government is to regard their construction activity or land acquisition activity as a valid credit for the purpose of offsetting GST liability, which typically comes on a deferred basis. There are a few rulings which over the period have emerged. So one of the most relevant one is safari retreats by the Odisha High Court. If you look at the judgment, it is in relation to a mall, and the court has held that mall is a specialty building. It is a equivalent to a plant for the developer, and therefore credit for construction of that particular property should be available. Pretty much something that this industry is wishing for. At the onset, I had mentioned that the core issue for any IT sector and since 2012 has been the concept of intermediary, which was introduced at that point of time. I think I may not be wrong to say that bulk of the issues or bulk of the litigation in this particular space today or are on account of whether the services qualify as an intermediary service. Multinational corporations, in this space, they have businesses across the globe and they carry out cross-border trade by making significant investments in a foreign country or seek economic advantage specific to that country. So in doing so, enterprises either set up their own office or procure services from a third party to facilitate overseas business activities. The concept of intermediary was introduced in 2012, right, at the time of bringing in the negative list. At that point of time, intermediary was limited to intermediation between two or more persons for services. In October 14, that was broad-banded to include intermediation of services or goods, including securities, for two or more persons. And then that definition pretty much continued even under the GST period, right? While the first draft of the GST law did not have the concept of intermediary, but in the subsequent draft that the government introduced, this concept was continued under the GST period. Over a period of time, government has issued several clarifications both under the service tax period and under the GST period. The circulars which you can see on the screen, 2019 and 2021, the most recent one, they fully clarify the government's stance on what should be the ambit and scope of intermediary services. So before we understand this, also from a global perspective, intermediary is not an alien concept, but largely in many countries, financial intermediary as a service has been exempt from taxes in those countries, in those economies. It is only in a few countries where some intermediary services, and in India, every intermediary services are subject to indirect taxes. If you look at the definition of intermediary services, the definition reads that intermediary means a broker or an agent or any other person by whatever name called, who arranges or facilitates the supply of goods or services or both, or securities between two or more persons, but does not include a person who supplies such good or services or both or securities on his own account. Which means if you are a principal party, which means you're supplying goods or services on your own account, then you are not regarded as an intermediary. But if you are a facilitator or you arrange that supply without actually making the principal supply, then you are regarded as an intermediary. Now this definition is very, very important. So let us understand what are the essentials, prerequisites. The concept of intermediary, like I said, is borrowed from service tax. So a lot of guidance is coming either from the service tax or those clarifications which have been issued under the GST period. Very, very similar to the service tax, the place of supply for intermediary services is regarded as the place where the service provider is located. So if the intermediary is located in India and the service recipient is located outside India, the place of supply for intermediary services will be in India, and therefore that service will not qualify as an export. Remember, we had seen the definition of export, and one of the conditions that you need to satisfy is that the place of supply should be outside India, which means if intermediary services are provided from India, then that supply would be liable to a C plus S, a CGST plus an SGST. So if you invert this, intermediary services provided from India to from outside India to uh, a recipient who is in India will also not qualify as an import of service, because the place of supply for intermediation services will be outside India, right? So uh, basically, if you have an intermediary or a commission agent who is, say, located outside India and who has an arrangement, for supply of services between two parties, and one of the parties is, say, outside India, and the other party is you, who's, the recipient in India, then in an ordinary course, that service would be liable under reverse charge. But because of these specific provisions for intermediary, the service will not be liable to GST under reverse charge. There are, in the GST education guide, etc., they've clarified and they've given examples of various players who may be regarded as intermediary, whether it is a travel agent or a tour operator, a stockbroker who's providing services to an FII or FPI, a commission agent, who is assisting or is an agent for buying or selling goods. So those commission agents are also regarded as intermediary. Recovery agents or reinsurance brokers, they're all typical examples of who is a intermediary. The primary requisites or primary requirements for the intermediary services, I think it's all coming from this in a small definition. If you look at it and interpret this as clarified by the circular, the concept of intermediary typically requires a minimum 3 parties. So you need to have a supplier, a recipient, and the intermediary. So these 3 parties are essential to call that arrangement as an intermediary arrangement, right? It is also not a case that every time there is a 3 party, it is an intermediary services. You have to fulfill all the limbs of this particular definition. So by definition, an intermediary is someone who arranges or facilitates the supply of goods or services or securities between 2 or more persons. It is thus a natural corollary that the arrangement requires a minimum of 3 persons. 2 of them are transacting in the supply of the principal goods or services, the main supply. And 1 is arranging or facilitating. This is called the ancillary supply. An activity between only 2 persons cannot therefore become an intermediary. So if you don't have an intermediary in between and you are the supplier and you have a recipient, then those supplies by definition can never be regarded as intermediary. Again, this provision is come under section 13 of the IGST, the place of supply. So intermediary, as a service is existent only when one of the parties or both the parties are outside the territory of India, right? So if you're dealing with, 2 or 3 parties who are all, within India, then, the place of supply is determined by section 12 and not section 13. And section 12, for intermediary does not have any specific rule, which means it will go by the location of the recipient. It will not go by the location of the supplier. So that is a important point I think you should note. These are, I mentioned that, you have the main supply and you have an ancillary supply. So there are basically 2 distinct supplies that you have to identify in any intermediary transaction. A person who is involved in the main supply on a P2P basis, which is called a principal to principal basis, cannot be considered as an intermediary, right? So, these aspects of the definition will help you analyze every transaction that you are reviewing to see whether those will qualify as intermediary. Some of the other requirements or parameters are that the character of the intermediary should be that of an agent, broker, or any similar person. The definition of intermediary itself provides that intermediary service provider means a broker, an agent, or any other person by whatever name called. So the expression used is means and does not therefore expand the definition by itself, right? So any intermediary therefore should first qualify as a broker, agent, or any person of a similar genre. The role that is played by the intermediary therefore is only supportive uh, and not on a principal basis. Subcontracting for a service is basically not regarded as an intermediary. Now, if you have a back-to-back arrangement, while there may be three parties, but they are under different contracts. So if A has agreed to provide services to B, and A further subcontracts a part of the delivery to C, then these are two distinct arrangements, two distinct supplies, and both these supplies are on a P2P basis, and such kind of supplies, therefore, by definition, cannot be regarded as intermediary supplies. The specific provision of place supply for intermediary services under Section 13 of the IGST Act, which is basically the place of supply, can be invoked only when the location of the supplier of intermediary or the location of supplier of recipient of the intermediary services is outside India. There are various examples given by the board in that circular. I would urge all of you to go through those examples in detail. They give you a good clarity in terms of what the government wishes to tax under this segment. Although I must also admit at the same time that the general understanding of intermediary services in the tax office, especially the state government level, is still not at a level which you would desire. So there is a lot of struggle in terms of helping client cases, especially refund cases, where the charge of intermediary is levied almost in every second case. There are enough number of rulings available on intermediary, and there are several rulings which have been deliberated by advanced ruling authorities, and most of the confusion actually is coming from the advanced ruling authorities, right? So for example, the relevant ones like GoDaddy was one very early advanced ruling that came on intermediary, and that was a favorable one. There was an advanced ruling from on in the name of VServe Global, and that was became the talk of the town when the ruling came. It was basically an unfavorable ruling for the assessee, and which regarded services which we all believed were not intermediary by the spirit of the definition as intermediary services. Recently several rulings have come from tribunals as well. So if you look at the Chevron Philip chemical ruling by Mumbai CSTAT, and there are several rulings for different sectors like telecommunication, etc. In fact, there is a recent ruling in the case of Vodafone by Bombay High Court in the context of international inbound roaming services, discussing the concept of intermediary. So those are relevant judgments or case laws that you should peruse while understanding what is the scope and the ambit of intermediary services. If you look at various arrangements that the client will have or clients have, whether it is a three-party transaction, say in the nature of sales support, what is the typical scope of work, right? That they will have. For example, in a sales support service, the possibly the service agreement will have elements such as soliciting clients for the principal, or receiving RFPs from government buyers, or customer liaison activity, which means basically understanding product specifications from customers, passing on the information to vendors, maintaining close relationship between the supplier and the customers, collecting comments and queries from the customers and communicating it back to the principal. So basically becoming a channel for communication between the two parties. making a tentative order book for your principal, or coordinating for timely delivery of products supplied by the principal to the customer, uh, managing or monitoring collection of payments. So all of these service elements are essentially characters, in the form of arranging or facilitating the supply of services between two parties, and those will be categorized as intermediary services. Uh, Generally, services like coordinating timely collection of payments from customers may also be coupled with other services which are intermediary in nature. So there may be a few arrangements or agreements which may have something on a standalone basis, right? So those will clearly have to be distinguished with arrangements which will typically have a mixture of what can qualify as an intermediary or otherwise. So for example, as an exception, if an agent is merely responsible for shortlisting the prospective customers for the principal, say from a database that is available or developed, but without any direct contact or communication with the potential customer, and say is involved in the execution function of support service such as say, customer profiling or initial due diligence, but without any direct interaction with third party, it can be argued that these services are on a principal to principal basis and should not be seen as intermediary services. But I think now we should get a sense of why and how robust documentation is a must for you to defend such situations for your clients. You could have procurement services support say given by an Indian subsidiary to a parent company who's located abroad, and a typical range of services that you could provide would include identification, evaluation of potential suppliers, to facilitate compilation of a panel suppliers, and bearing in mind the quality standards etc that the parent would want, arranging say standard samples from the parent for distribution to say the Indian suppliers, placing the orders, negotiating contracts, or facilitating technical analysis. So if you have such characteristic in your arrangement, in your customer contracts, then they are all in the nature of arranging and facilitating supply between two parties, and more likely than not will be categorized as intermediary services. But if you have a two-party arrangement, say of the nature of marketing research, where say research is basically undertaken based on market available data like a product survey, a consumer behavior survey, a competition survey. These are manners in which these research data is generated, collected, even analyzed. In some cases, a generic marketing activity or a brand promotion campaign, which is more generic, right? So, for example, to place like a banner in a social media, etc., without really getting involved in interactions with potential customers or buyers. So those kind of pre-sale activities where only two parties are essentially involved in supply and receipt of the service, those essentially should be regarded as non-intermediary services, and therefore if the customer is located outside India, typically this should be regarded as a export of service or zero rated supply of services. I spoke about a few examples in the telecom space. So if say Mr. Utkarsh was located in UK, and he came to India on a visit, right? He would typically initiate roaming services on his phone, and what will happen is he as soon as he does that, he will latch onto some network operated by an Indian telecom operator, right? But the arrangement for latching on, charges, etc., they're all agreed between the Indian telco and the foreign telco, and these their services therefore are independent activities, and such kind of infrastructural support services cannot be regarded as intermediary. In the case of Vodafone, Mumbai CSTAT, and now the Bombay High Court have held that such services in relation to roaming in India are or cannot be regarded as intermediary services and will be regarded as export of service. There were examples quoted by CPIC in circulars, regarding call centers, and it is a debatable issue whether call centers who provide services to their clients by dealing with customers on clients' behalf could be construed as intermediary. The education guide, provided the service tax education guide, and this 2019 circular, they provide examples around what within a call center could qualify as intermediary and what would be outside that scope of bandwidth. If a call center merely resolves queries of customers as per a standard operating procedure, remember we spoke about the business process management industry, and we understood that if there are set processes, standard processes, and these processes are typically written in a document so that anybody can come and execute. So these are called SOPs. If a person is merely addressing elements based on an SOP, without doing or generating or soliciting customer for product or services, then those kind of activities are not in the nature of intermediary. But if you start making random calls and identify prospective buyers, you transmit information about products and services of your principal, you generate interest in sales, you take sales targets. So a lot of investigations today, they get into accessing servers, emails, the KRAs, your job description. So those are elements which are typically reviewed now by tax authorities, and they can clearly make out whether you are engaging in enhanced activities beyond and which can fall into the lap of being called as intermediary services. Advisory services or consulting services are again very, very common in the IT space. So if it is a pure play advisory, non-binding advisory, typically these are not regarded as intermediary services. In a very broad summary, I think the most important element on intermediary services that you should understand is the strength of your documentation is going to drive the outcome. As Supreme Courts have recently held, as important as the form is important, also is important is the substance. So if the substance is missing, your managing documents in a certain manner is not going to really help. So the entire substance and form story needs to be built in to ensure that the services do not fall under the trap of intermediary, and if they do, they are liable to GST. Moving on to specialized centers which are typically available to companies operating in the IT space. SEZs, are demarcated zones. They are special land areas which are notified as special economic zones, and the legislation for SEZ is basically called the Special Economic Zones Act 2005. There are rules notified under this act. For STPI, which are also regarded as 100% export oriented units, the relevant legislation is the Foreign Trade Policy and the Handbook of Procedures. So that's the relevant legislation. STPI is, unlike SEZ, can be set up in any domestic DTA and be registered as an STP unit by the concerned director of STPI. There are basically two primary commercial options that an IT unit will typically have, or an export-oriented unit will have. Is one, either to set up under these are basically typical IT development hubs or a BPM or a global in-house center or a capability center, like we understood as being the BPOs and KPOs who serve clients outside India or who serve their global operations outside India. So they could be captive centers or they could be centers of servicing customers across the globe. These are the typical kind of units which will set up either under SEZ or STPI model. Right? The there is one SEZ in India which is in Gujarat, in GIFT City, where unlike the other SEZs in rest of the country, any service, whether it is IT service or a non-IT service, the unit can be set up as a SEZ unit in that particular state. So for example, if you were a chartered accountant practicing and providing consultancy or compliance services to say a client who's outside India, and that is the core of your activity, you could also set up an office in GIFT City, in the state of Gujarat at Gandhinagar, and be registered as an SEZ unit. It is possible only in that particular SEZ, because it's a multi-services SEZ, and the other SEZs in India are generally multi-product SEZs. The apart from location, in terms of benefits, they're fairly comparable. SEZs are far more tempting in terms of incentives and benefits than as compared to STPI. From a customs perspective, custom duty exemption, upfront exemption is available both for SEZ and STPI. For custom, SEZ is regarded as a territory outside India. It is regarded equivalent to a custom station or a custom port. STPI does not enjoy that status, but there is an exemption from payment of custom duty if the assets are used and housed within the STPI premises, the licensed premises, and used for authorized operations. So the end use, the location of the asset, actual user condition, they're all very, very relevant factors while availing any custom duty exemption on any goods that are imported in either the SEZ or the STPI. So you're allowed this exemption only if you're using it for business purpose or authorized operations. Otherwise, the exemptions are typically not available to you. In service tax, there is a special provision which regards supply of goods or services to an SEZ unit from within India, also as a zero-rated supply, which means, as a vendor, if I'm supplying goods or services to a unit in SEZ, an IT unit in SEZ, I can pretty much make that supply without payment of GST as a zero-rated supply. There are compliances that one has to undertake, ensure that the supply is listed in the authorized list of services that are allowed to be consumed by the unit. There are requirements for endorsement of invoices by the specified officer. So if the unit is undertaking those compliances, pretty much as a vendor, as a supplier, you can make available those supplies without payment of GST. Refund is available of input tax credit is available to an SEZ unit. Refund is available even to an STPI unit. A rebate is available. Rebate, basically is a situation where you paid GST on the outward supply, on the services that you've exported. If you offer GST on that within SEZ, that rebate is also eligible for being refunded. In an STPI, rebate is available only if you've not availed any duty-free exemptions. If you have availed, then rebate is typically not permissible under the GST law. Apart from the territorial elements, SEZs are typically governed by the development commissioners. So every state will typically have a development commissioner who will govern all the SEZs in that particular territory. For you to register as an SEZ unit, you need to make an application before the SEZ development commissioner. they formulate what is called a unit approval committee, which looks at and deliberates, the application. And then if they're satisfied, they allow you a approval to set up as an SEZ unit. Similarly, in STPI, if you were to set up as a unit, you need to make an application and project report, etc., of a very similar nature as SEZ, but before the director of STPI, who would again look at those applications and typically approve the project. Once approved, you can set up your office as an STP office and avail duty exemptions and other incentives that are typically available to SEZs or STPI. The concept of bonding or warehousing or calling this as a warehouse, customs bonded warehouse has been done away with. So both SEZs and STPI are now self-regulated zones. So you need to appoint an authorized person who would typically take care and be responsible for all the compliances if you are a unit registered under SEZ or STPI. Customs, SEZ is a customs controlled zone. So for entry and exit, you typically need ID card or access or approvals to get into the zone. For STPI, they're not regulated as such, but their self-regulations do apply. There was a recent change, and this is as recent as 14th of July. I think we discussed that, because of COVID, while work from home was not a new concept, but we were all forced to look at this concept so closely for everybody. And, everybody saw situations, scenarios where 100% of our employees were, working from home or, from some other locations outside office. Now, in a typical SEZ and STPI, because these are regulated entities, regulated zones, the requirement is that employees should utilize that infrastructure and work from those premises physically for delivering services which are exported out of India. But because of the fact that people were incapacitated from getting to offices or reaching offices, there were dispensations given during the COVID period, and they're available even till date, to allow employees to basically work from anywhere, work from home. There was a continuous representation from the trade that this work from home as a policy be allowed perpetually now for all the employees, because the entire culture or ethos of working in an organization has seen a major change, right? So organizations, it is very, very common for organizations to allow employees to continue to work from home either all the days or a few days in a particular week, right? In fact, organizations which have been rigid on this front have seen a lot of people moving out of such organizations, because people or employees generally now want to see those flexibilities or hybrid policies, and they want to take advantage of being able to work from anywhere. As an IT sector, the infra is so developed now in the country that anybody can work from home, and these times have been tested very well during the COVID period. The central government, which is basically the Ministry of Commerce and Industries, issued a notification in the context of SEZs recently on 14th of July. And as per the notification, they have basically allowed units a procedure, a path to apply for employees to basically work from home. The and this permission can be taken for both permanent or contractual staff. It is typically valid till 1 year. 50% of the total strength of employees can receive the approval. if you need higher approval, you need to basically present a case before the DC, and the DC has been empowered to approve such higher ratio if he's satisfied. For all units which are in existence today, the timeline given for making an application is 90 days from the date of this particular notification, which is 14th of July. If IT assets like laptops and uh, you know uh, you know video or audio equipments are removed and given to employees so that they can work from home effectively, and these are duty-free assets, then every unit needs to undertake certain processes, and those processes will have to be followed and customs approvals will have to be taken. But removal duty free is typically allowed. The validity of these approvals now will be coterminous, which will be 1 year. So there are, unlike in the past where there was a uniform rule which allowed a blanket permission to all the employees to work from home, and under the amended rule, you will have to follow an approval process. The duration and the limits have been specified, so there is clarity that these approvals are available at least for 1 year and then needs to be renewed every time. Procedures for removal of assets, etc., have been clearer than they were earlier. The time period for which approval permissions are or removal of assets permission is given is also a significant change and linked to the approval given by the development commissioner. The the next topic, which is state incentives, again a very, very important subject for chartered accountants who are dealing with clients in IT and ITES space. A lot of states like Maharashtra, Telangana, Tamil Nadu, Gujarat, Karnataka, they've all come up with specialized policies for IT sector, so that the IT sector can survive in this particular states. The reason why those policies were brought is to attract talent. Once you have organizations coming in, talent coming in, the entire ecosystem develops, right? So employees come and you take houses on rent, and they there is local employment that is generated. Consumables are consumed within the state, so state gets a lot of revenue, and therefore these states have come out with policies to give a lot of incentives to new projects or expansion projects by various clients in this particular space. The various forms of exemptions are in the form of stamp duty exemption, whether it is full or partial, the GST reimbursements. In many cases, electricity duty or power tariff relaxations are given. In a few cases, there are investments linked to capex. So you may be regarded as a mega project if there is a significant capex that you're making or a significant employment generation plan for that particular project. So what you see on the screen are some of the criteria that you will typically find in a IT policy, and this can be capex. This can be linked to the location of the project, the IT project, the minimum capital that you need to bring in, local labor conditions. So, for example, in Maharashtra, you need to have minimum level of employment generated from domicile citizens or Marathi talking employees, and at key designations, local employees need to be deputed. In Karnataka, there's a requirement to have 50% employees coming from within the state. The fiscal incentives are typically linked to capital or expenditure or output sales. Uh, for example, these incentives given under the foreign trade policies, like SEIS scheme or the SFI scheme in the past, they were all linked to performance, all linked to sales, and the capex that was required. So an EPCG typically is a scheme available which is linked to capex. And what is the requirement of capex? And then you need to perform as a unit and generate additional sales from the export market. The location of your project, the investment that you make, the sector that you are in, employment that you can generate are important criteria for negotiation with state governments, especially if you're dealing with a mega project. I mean, I'll quickly move, on these slides. There are, states like Tamil Nadu, they offer a lot of incentives to IT units. They could be in the form of capital subsidy, depending on the zone that you are. You get exemptions from stamp duty and electricity duty. Administrative procedures are largely eliminated. Stamp duty exemptions are given depending on the location of that particular enterprise. But all these states will also have a local employment criteria. Likewise, in Telangana, there are exemptions or relaxation on stamp duty, power tariff, energy saving initiatives. So if you're generating your own power through say a solar plant or any other eco-friendly initiative, the government typically funds a part of those capex in the basically based on the state policy. The outlier as far as incentive policies are concerned is basically the state of Gujarat. As you would know, Gujarat state, not many IT companies have arrived in that particular state. So they need to be differential in terms of attracting new companies, new talent. And if you look at the kind of incentives that they've given or the scale of incentives that they've given is at a absolutely different level. In the state of Gujarat, there is a new IT policy that has been introduced on 7th Feb 2022, which is this calendar year, and it is valid till 31st March 2027. So if you have a client which is in that state, which is either already operational or which intends to open an office and covered under any of these definitions, it's not a typical IT definition. It is a very wide definition that they have given under the state policy. The policy is available on Google. Please Google and draw a copy. It's not very difficult to read this. So call centers, a back office, accounting support services, insurance claim processing, because you have GIFT City also housed in the state of Gujarat. So a lot of GIFT City related sectors have been included in eligible categories. If you have a IT enabled bank, NBFC, or asset management company, market making company. So all of these are also regarded as eligible ITS. So this is not a typical definition that you'll find in all the other states, but this is very, very unique to the state of Gujarat. The eligible incentives under the state have been given in the form of OPEX, CAPEX, and the third bucket is basically linked to employment. So if for OPEX, the eligible the proportion is basically 15% of the eligible expenditure. What are the eligible expenditure? Lease rentals are eligible. Bandwidth related expenditure, is eligible. Cloud related expenditure is eligible. Power tariff and patent. Provided, these expenditures have been made from a service providers located in India. There are, measures and quantum of, incentives or quantum of eligible OPEX has been mentioned for each category. You'll have to go through that in detail, understand that for your client before making an advice. But 15% of this this total amount is eligible to be paid back as an incentive. For a unit which is not a mega unit, which means your capex spend is less than 250 crore, then you are eligible to an incentive of 15%, but capped to 20 crores per year. Or if you are a mega unit and your capex is more than 250 crore, then the limit is enhanced to 40 crores per year. This is typically available for a period of 5 years, which is coterminous with the period of the policy. Moving on. These are basically employment related incentives. So this is so unique to the state of Gujarat. No other state have these kind of incentives. For example, if you are generating local employment, the state government will pay you 15 days salary, basically 50% of 1 month's salary for every male employee capped to 50,000 rupees and female employees capped to 60,000 rupees. But these are local employments that you generate, a new employment that you generate, and it is unique to that particular employee. So once in a lifetime for that employee, these incentives are typically granted. The most important is this Atmanirbhar Gujarat Rozgar Sahay. So employers' contribution of Provident Fund is given as a reimbursement, 100% for female employees, 75% for male employees, without any upper capping for eligible units, for eligible spend. If the amounts are deposited in the state of the EPFO office in the state of Gujarat, and you have taken requisite registrations, with the Department of Science and Technology in the state of Gujarat, you will be reimbursed this amount. And in terms of organizations like IT sector, which are people oriented, a lot of people intensive sectors, including GICs, GCCs, this can be a reasonably large amount of incentive. For capex, what is given back to you is 25% of the amount that you spend. These are capped at 40 crores if you are a non-mega unit and 200 crores if you are a mega unit. So the quantum of incentives and the quality of incentives both in the state of Gujarat are far better if you compare it with any other state. And of course, the reason is Gujarat needs to be an attractive destination, which most of the other states are today for IT and IT-enabled services. Moving on to the last segment that I spoke about the start of my session today. What are the opportunities available to you, as a CA professional? You may be in practice, you may be employed in a consulting firm, you may be working with any organization, but there are so many opportunities that you as a chartered accountant can take to your clients. It could be as simple as obtaining so many GST registration that they have to obtain in every state. There's a requirement to obtain import-export IC registration if they're engaged in export or import of services or goods. You need to register with the trade association, so they typically give you a certificate. It is called an RCMC, registration cum membership certificate. So and these registrations have to be renewed periodically. If you are set up in an SEZ or an STPI, then it's a completely different world for practicing in these areas. Right from getting registrations, renewal of registrations, dealing with daily activities, compliances that you have under STPI and SEZ schemes. There is just a lot of things to offer to your client. A typical GST, returns or compliances, or filing or assisting your clients in refund claims. This is a very large area as far as IT companies or software companies are concerned. We saw that there are so many incentives given by state and central government, and in fact under the new fund rate policy which is in works, and which is likely to be announced in this calendar year, there is an expectation that there will be new categories of incentives given by the central government also for services units, especially in the IT field. Whether you are consulting, advising on various topical issues like an intermediary on your clients, or you managing work from home compliances, they are very, very difficult to manage, given the current construct. So many certificates are required to be issued by chartered accountants for companies while filing refund claims, while filing APRs, annual performance report, accounting, bookkeeping. So there's just too many and countless opportunities for all of you chartered accountants in this particular sector. With this, I'm just opening up the forum for any questions. There are a few which have come in the chat box. Let me take some of them. But please post your questions on the chat box.
Yes,
So-
thank you. Thank you, Amit. So first question that we've got on the chat box is, in case of non-receipt of Forex, in the case of export of services, when does the liability to pay GST arises? If
So,
yeah.
if you have not received your consideration in Forex, the time limit given by the law is 1 year. Then on the expiry of that period, within 15 days, you need to deposit the GST on that supply.
Sorry, sir. There's another question which says, has Gujarat government notified GR for new IT policy for implementation? Where can I find online registration for availing benefits under the Gujarat IT policy?
It's a very good question, Kalyani, and the Gujarat government has recently notified the implementation guidelines for the new IT policy. It is available on the Department of Science and Technology website. If you Google implementation guidelines for Gujarat IT policy, you will be able to go to that particular link and download. It's a very important question because the guidelines specify that from the date the guidelines were issued, which is the last 10-12 days, they require every unit which is already operational in the state of Gujarat and who are undertaking expansion and want to be eligible for claiming incentives should apply within 30 days of that particular implementation guidelines. And if they fail to do so, then incentives are not available to that unit. So if you have clients, if you are an entity which is otherwise eligible for incentive in the state of Gujarat and you're already operational in that state, please go through the guidelines. If all the procedures, links, etc. are available in that document, and make sure that within 30 days of those guidelines, you register with the Department of Science and Technology.
Thank you, sir. If there are no further questions, then we can conclude the session. Our WRC team.
Hello.
Yes, if there are any questions that you have received.
No, sir.
Okay. Then should we proceed with the conclusion? Okay. So I would. First of all, Amit, thank you so much for gracing this occasion and sharing all your inputs on the scope and the opportunities available for chartered accountants. These are certain niche areas which all and everyone should think of, and hopefully we get opportunities. Thank you for explaining us the impact of GST on the IT and software industry, in terms of taking us through the overview, the subsectors, export of services conditions, pre-GST regime, etc., etc. Then GST applicability on softwares, mixed supply, composite supply. You have covered various topics in this 1.5 hours, and we are really thankful to you. On behalf of all the participants attending this session, I extend my vote of thanks to you. Thank you so much.
Thank you so much.
Thank you.
Thank you.